I've had a couple of requests to go over capital budgeting. We will hold a collaborate going over this, but this is the week 6 question. So I thought if I walk through it here, it might help assess, especially when we start looking at future assessment, which has this involved in it. So what I've done is I've kind of set up my spreadsheet a little bit. It's always a good idea to use Excel for this. I've got my question up here. I've started populating this. I'll talk through it so you understand. So this is my data information. And then over here, I've created the basis of my cash flow statement. So before I start talking, I just want to highlight a couple things. So this is looking at cash. Okay, so it's very important. If we've got our accounting heads on, we kind of need to forget the accrual side of things. We're just thinking about cash, cash in, cash out. So make sure you've got that at the forefront of your mind. And also when we're doing this, we're looking at old versus new. So is there a benefit to changing to a new thing, or is there a cost to changing it, or like zero benefit at all? So when we're looking at things like change in depreciation, we are looking at the net change. So you'll see it as I explain, but just remember that we're looking in the cash difference between the two projects. We're not forgetting about the old and just looking at the new, we're looking at the cash difference. So that's really important. Okay, so this is the question here. I'm going to make that in italics just so we know what we're looking at. What I've done is I've extracted the key information down the bottom here. Great, now my battery's on low, so let me plug that in quickly before I start. One moment, team. All right, let's get cracking. We now have electricity. Okay, so now with these questions, we get a lot of wordy stuff. So I find in finance, it's always best to extract the information we need, which is why we have a data table. And for this capital budgeting question, it is really important to have that, because it makes, when we're working with our cash flow and our calculations, it makes it so much easier, trust me. So as I read it, I'll explain how I've extracted the information. So the first bit is about the old machinery. So they're using a machine whose original cost was $84,000. Bam, there's my original cost. The machine is 2 years old and has a current market value of $20,000. So that means current market value. That means what could we get for the machine if we sold it today? 20 grand. Its current age is 2 years old. The asset is being depreciated over a 12-year life at $7,000 per annum for tax purposes. So I've got that $7,000. I might write per year. Let's keep my wording consistent. No expected salvage value at the end of its 12-year life. So that's saying that there is 12 years of it, and I've just done a little calculation of the life that's left, probably unnecessary. So there we go. I've extracted my important information here, and that's all we need to know about our old machine. Okay, so now we're looking at our new machine. So this is my information we have for our new machine. So let's highlight that in pink. So management is contemplating on purchasing the replacement machinery that costs $90K. I've got my cost there, and has an estimated life of 10 years. There's my life of 10 years, and has a salvage value of $20,000. There we go. So that's what we'll get if we sold it in 10 years' time. The new machine will have a greater capacity, and increased sales revenue are expected to increase gross margins from 1 million to 1 million $1.015 million. So we've got an increase in sales by $15,000 per year. Now, what I said at the start is we're not scrapping the old machine and just looking at the new machine as a silo. We're trying to look at the change effect. So we've got an increase by flipping our machines. Our overall position is going to increase by 15 grand per year. So it's an increase of sales, so increase in money coming through the door. So that's a positive figure. So money coming in the door, positive figure. So I'm going to highlight this in a different color. Let's highlight that in a blue. The next part is operating efficiencies. With the new machine, we'll also produce expected savings. So that means our expenses are going down of $12,000 per year because of annual operating costs of the new machine are $17,000 compared to $29,000. So that $17,000, $29,000, irrelevant. They're already giving us our $12,000 piece of information. So what's that mean is we are saving our expenses. So our expenses are going down, which is better for us. So that's a positive in our cash flow sense, right? So I've got my $12,000 there. If it says it was going to cost us an extra $12,000 per year by having it, we would need to make sure we put that negative there. Or if it says we're going to lose money, so you can see I did a little formula there, this would be a negative here. Okay, so it's important that we use our positives for money coming in the door and negatives for money going out the door. I find it really helpful to think about it, money in and money out. Okay, and then what is it saying? Depreciation is on an Australian basis at 10% per annum. So what I've done is, this is back up in my machine area. I've just calculated, okay, what is my annual depreciation here, which is $9,000. Okay, and two last pieces of information. Cost of capital is 16% and tax rate is 39%. Very high tax rate. So let's highlight that in a different color. Okay, let's go orange. So that is the data I need. I can now ignore all of this. And what we're trying to do is figure out, should we replace the old machine with the new one or not? So if it's going to result in a positive, net positive, then we'd say yes. Neutral, then it would be dependent on probably qualitative factors. If it was a negative, then we'll probably say no. But when we're making these decisions, we need to think about quantitative, which is our numbers, and qualitative factors, which is the other aspects, not tactical. Okay, so let's start populating our information. So we've got our cash flow statement, and we've got it starting at year 0, which is today, and then I've extrapolated it for 10 years, which is the life of our new asset, right? Cool. So now what we need to do is, in order for us to go to our new machine, we need to get rid of our old machine. So first off, let's deal with our old machine. So we know that we're going to have a salvage value of 20 grand. So we know that if we get rid of it today, it's going to be worth $20,000. So that's $20,000 coming in the door, right? Cool. Now, that's really the only cash exchange from getting rid of this old machine, right? But then we also need to look at the tax change of getting rid of the machine. So let's have a think. The machine is only 2 years old. It's got 10 years left in its life. So what's its current book value? So I'm going to insert a row above. Go current book value. So we've got 84,000 minus 2 by our depreciation per year, right? So we've got a book value of $70,000. Okay, and that means that we have future tax depreciations of the annual depreciation. So what we need to do is we need to look at our tax impact. And when I am talking about tax in our, obviously tax, if it's payable, it's money going out the door. If it's receivable, it's money coming in the door, right? So what I've done is I've looked at our current book value. So let's go our current book value. Then what we want to do is figure out our minus our salvage value. Okay, I might just do some brackets around there. Okay, so that is kind of what we're missing out on in a tax sense, times by our tax rate, which is 39% there. So 19,500. Now, that is a tax impact, but I'm going to just write a benefit here. Why is that? That is because we can depreciate the assets that are recorded in our balance sheet and get a tax write-off for that. Okay, So because we're getting rid of this machine earlier, we then have a book value of something that's worth $70,000, but we're only selling it for $20,000, right? So what happens with that $50,000? That's a write-off. So we get to deduct that when we do our taxes. So we don't want to include that $50,000 because that's not really a cash transaction, is it? That's just a write-off of an asset in our books. But the actual cash benefit we get is a tax deduction of $19,500. So that's going to have a cash positive impact in our books. Okay, so now we've dealt with everything we need to deal with our old machine. We've written it off and we've sold it. Okay, so we're happy now. Now we need to go to new machine. So this is all happening immediately in order for us to purchase it. Okay, so what we do is we've got to go, what is our cost? Okay, we have to buy it. 90 grand, that's money going out the door. Now, I just made a mistake there. It's money out the door. We have to make sure that that's negative. Money out the door, okay? And then is there any other additions we need to make? No, because our benefits, which are here, our depreciation, which has our tax change, tax impact, is going to happen when we start using it. So year zero is just about really in with the new, out with the old. So let's look at our total. I'm just going to do a sum here. And I'm going to carry this along to year 10. Cool, so I've done that now. Now, we're going to look at years 1 to 10 now. So this is looking at our cash flow things. We've already dealt with the cost. So I think what we might do now is first look at the benefits. Oh, I'm not very good at spelling. This is why I did accounting. So let's insert some rows. Might need to insert a couple more. All right, so we've got our increase in sales is a benefit, and we've got our operating efficiencies is a benefit. Okay, so let's just go 15 and then we'll go 12. So you can see why I have my data table is because look how easy it's making my life when it comes to the cash flow. And how I can lock that, so I can just drag it across, because if I just drag it across like this, it's going to pull in some wacky figures, is I just use my dollar signs. So in front of the B and in front of the numbers, and then I can just drag it all the way across and it keeps those figures locked. So just FYI, I'm using Google Docs on my Mac. In case you're wanting to know, but if you've got a Windows and you're using the actual Excel tool, it will be exactly the same here. Okay, so I've just pulled in the benefits, and remember, as I said, increase of sales, that's money coming in the door. We're saving on our expenses, so that's extra money in the door, right? So that's cash flow impact, that's why I'm including it, and they're all positive. So cool, great. Now, when we've got those, they've got tax impact, right? And because we've got money coming in the door, that means we're going to have tax payable. So let's call this a cost, okay? So how do we calculate that? Let's go 15 plus 12, right? So that's what we want to calculate our tax on, times by our tax rate down here of 39%. Okay, so, but remember, I made a mistake. We've got to put in our negatives to make it a outflow, cash outflow, because I've said it's a cost, money going out the door. So let's bring that across. Oh, so you can see here, I need to lock my tax portion here, because if I drag it across, I won't have my, it will carry forward all the figures going across here. So now I can drag it across. There we go. So I've dealt with this portion here. So that is completely done. Now the last thing I need to deal with is depreciation. Okay, so let's call this depreciation tax impact. Now, remember, as I said, we're not getting rid of, in theory, when we're doing our cash flow statement, we're not just looking at the new machine as a silo, we're looking at the difference. So that's why we're looking at here the benefit in sales and the benefit in savings. Okay, so here we don't want to just grab that $9,000 in our depreciation. We want to see, okay, from our old machinery to our new machinery, what's the difference? Okay, now our depreciation has increased by $2,000, pretty obvious there. If we've got an increase in expense, what's our tax impact? So increase in expense, that means we're going to have a bigger tax deduction. And what does a tax deduction mean? It means money through the door. So let's call that tax benefit. So let's have a calculation. So $9,000 minus $7,000 times by our tax rate, okay? And that means it's a $780 tax benefit. Now I'm going to have to lock these, otherwise it's going to drag across some funny figures. Let's drag that across. Okay, so you can see now if we look at the answers, I've done everything but what we need to do in year 10. So let's insert some more cells. Above, how many am I going to need? 2. All right, let's go sale of new machine. So we know, or not really sale, let's say end of life of new machine. So we know that the lifespan of the new machine is 10 years. It says it here. Our cash flow goes up to 10 years. So that means at the end of the machine's life, we need to then consider the salvage value. So what can we get it for it? So salvage value. So at the end of it, salvage value, that means money coming in the door. That's our $20,000 figure. We include that. Now, the next thing we need to figure out is our tax impact, like we did up here, okay? So what did we do? We looked at what is the book value. So let's do that. So let's look at book value at the end of life, okay? So our book value is our cost, okay, minus our annual depreciation times by the life. So it's nil, okay? So that means that we don't need to make any tax adjustments. We're not writing anything off. So when we do our tax, we are just calculating it on the money we made here of our salvage value. So if we've just sold it for 20 grand, in our books it's worth nothing, that means we have to pay tax on that 20 grand, right? So tax impact, it's a cost. Money going out the door because we have to pay that tax, right? $20,000 times by 39. 7,800. Now, what did I do wrong? It's a positive. It needs to be a negative because it's out the door. It's negative 7,800. 29,450. Now, let's jump over here. Have I done it correctly? Here are the answers. Yes, I have. Woohoo! So, that's it all done. That is our capital budgeting cash flow. Now what I've done is I've included some extra things that we need to do. So I've got, next what we're going to look at is our accumulated cash flow. So this will just help when you're doing, our payback period here. So what I'm trying to do is look at, okay, this is what my net position is, and it's a negative obviously. So when am I going to break even in essence? So actually I can't do that. So here I used my 50,000 minus my first year cash net inflow. Here is the accumulated amount left over minus the next year. I can just drag that across and I can see the changes. So I know that under 3 years I will pay it back. So I can go 2 years because we've got 2 years there plus 1 minus 12,500 to the power times by that. So, well, that didn't work out, did it? 1 plus. Ooh. Over. All right. 1 minus. Okay. And that's my payback period. So what did I do? 2 there plus 1 minus 12,500 over 17,250. And that gets our payback period. Okay, next, to calculate our PV. Now we know that our cost of capital is 16%, so what we need to do now is to discount our cash flow. So let's do that. We have 17,550 divide by, this sounds very familiar, 1.16 to the power of 1. Let's put some, actually, let's just do it like that, and oh, I should be able to drag it across there. So that's our discounted annual cash flow. Let's put some dollar signs around that. Now we'll do our accumulated cash flow minus that. Oh, I should be using the plus sign. And I can just drag this along. Now with this information, I can now figure out, okay, so our discounted payback period will be 4 years. Let's just use, which equals 4 plus brackets 1 minus that over that. Okay, so that's our discounted payback period there. Okay, and then now we can do our PV, which is just the sum of our discounted cash flow period. Ooh, what have I done? Oh dear. Sum 86,000, and our net present value is our 86,000 minus our 50,000. You can see I did a plus because that's got a negative and that will result in a minus. Okay, so our NPV is 35,000, both are positive. So far I'm wanting to accept this new project. And then our IRR is here. This is really helpful. It's giving me the cash flow amounts. So I highlight that, comma, my rate, 32.59%. Okay, so it's done. I've calculated all this. I know that, yep, NPV is positive, PV's good. I'd probably accept it. But we also need to consider other parameters. Maybe the question would give us, like, we want a payback period of under 1 year. And this is 2.9. I'll be like, oh, it's not really meeting that criteria. So the question could give you a whole bunch of different things that they want to meet in order to accept a project or not. And then you need to make decisions on that. It could also be that, say, maybe this new machine is saving us a lot of money, but it's really bad for the environment. So is it worth it? So lots of other things we need to consider. But that's how we do it. Hopefully that my logic of explaining it with the cash in, cash out, and also really understanding that we're not looking at the new machine as a silo. We're looking at it as the difference between the new and the old. I think those two are very important. Hopefully that helps. Any questions, post below. Thank you.